Welcome to Unlock Financial Independence, the #1 financial independence podcast for physical therapists. I am your host, Matt McClanahan. Welcome back, my financially savvy physios. I am your host, Matt McClanahan. Thank you for joining me for another episode of the Unlock FI podcast, where I help physical therapists just like you unlock your path to financial freedom while working as a PT. If you're new to the channel, welcome. And for new and old listeners alike, make sure you join and engage in the Facebook group, Financial Independence for Physical Therapists. Lastly, subscribe to the once per month newsletter, which will be linked in the show notes below for monthly tips on things like travel hacking, the state of student loans, listener wins, and so much more. Okay. On today's show, we're talking about investing and index funds. All right. But real quick, before we jump into the show, I want to try and be as transparent as possible, not only financially, but also with how I go about researching for these episodes. I use a note-taking app called Notion. Recently, they integrated AI into their system. I used it to help develop an outline for today's episode and to gather ideas on what various definitions are. I reviewed all of it for accuracy, so everything I say today are my opinions, and I created the final edit. But with AI continuing to increase and be involved in our lives, and you don't know who wrote what anymore, I thought I'd say moving forward, you can expect that I most likely have utilized the Notion AI in some way to assist with my aggregation of information and layout so I can speed up the process of making these episodes, but I edit it all for clarity and to make it digestible for you. So anyway, thank you to Notion for helping me out. Now let's get on to the show. If anybody has any concerns about that, let me know. Say, Matt, that's fraud, man. You can't be using AI to be doing your homework for you. And I get it, but it definitely brings down, lowers the barrier to entry for aggregating all this information into one place, and then me going through and just synthesizing, trimming the fat, so to speak, and cleaning up. So open a conversation on that for sure. Okay. But back to the show. Today, we are talking about investment accounts and investments. And so if you were like me, you're like, there's difference between those things. And there absolutely is. And I have a fantastic analogy for you guys today. The difference between an investment account and an investment. Okay. So let's go over what are some examples of investment accounts. So a brokerage account. You have employer-sponsored retirement accounts, and these are things that you're familiar with, right? 401k, Roth 401k, a 403b, simple IRA, SEP IRA, and a 457. Those all fall under an employer-sponsored retirement account, okay? You also have individual retirement accounts. So that will be something like a traditional IRA or a Roth IRA. You have self-employed retirement accounts, so a solo 401k. You also have education savings accounts, so a 529 savings plan is an example of that. And you also have health savings accounts, which are very straightforward, HSA, and I think FSA falls under that as well. So investment accounts, broad categories again, are brokerage, employer-sponsored, individual, self-employed, education savings, and health savings accounts. Okay. So moving on to investments, I kind of want to lay out what investment accounts are, what investments are, and then we'll get into the difference between those. Okay. So investments are things like you've heard of: stocks, bonds, mutual funds, ETFs, also known as exchange traded funds, CDs, certificate of deposits, not those things that we used to mix back in the early 2000s, retirement plans. So there's several like under that category. Options trading, which is day trading. Don't recommend, but it's an op form of an investment. Then there's other smaller things that we won't dive into, but that you should be aware of: annuities, derivatives, commodities, stuff like that. So big things that you should know with investments are going to be like the stocks, bonds, mutual funds, ETFs, CDs, and options kind of trading. Okay. So let's think about an analogy for investment accounts versus investments. Okay. So say you want to get your legs stronger now so that you can get off the ground when you're 70 years old. That's a great investment. What a great investment. Starting now will have huge effects over time. So this is no different than deciding that you want to invest money right now so that you can retire later. Okay. But there are so many ways to exercise, particularly to get your legs stronger to meet your goal when you're 70, right? Stronger legs so you can get off the ground when you're 70. You could do CrossFit, Zumba, Pilates, powerlifting, hire a personal trainer, etc. So you have all these different ways. All of these are avenues by which you could engage in working towards your goal of strong legs by 70, but they have not started working you towards that goal. So if you sign up at a gym but never go to class, you can't reap the long-term benefits, okay? This is like opening an investment account or a gym membership and never putting the money to work in that account or never going to the gym. Within the account, the money has to be told what to do. Similarly to when you want to get your legs strong and you've chosen powerlifting as your method by which you will do that, you have to show up for the workouts to actually get the changes, okay? Now that you want to stronger legs or want to invest, and you will do that by powerlifting, you've chosen your investment account, you have to go to the workout sessions and make your deposits in the form of sets and reps. And this is where you choose your investment type and you feed it dollars. You can do leg press, squats, leg extension, etc. There are a million and one ways by which you can progress towards your goal. This is no different than choosing what type of investments to do. In financial independence cases, this is usually in the form of low-cost index funds. Now that we know that investment accounts are different than investments themselves, let's chat a bit about investment accounts that are more common and are previously mentioned, but take it one step further. Some accounts can be tax deferred, others are tax exempt. So let's tease out what each of those means exactly. So if we go back to our investment accounts, remember, those are going to be things like your 401k, Roth 401k, 403b, simple IRA, traditional, and Roth IRAs. All those, what we want to do is talk about the difference between a tax deferred and tax exempt account. Okay. So tax deferred investment is an investment when the taxes on the income earned, capital gains, and dividends are deferred. So we're saying, hey, we're going to take the taxes and hold off paying anything until later. Okay. So many companies offer employees in a plan that you're familiar with called a 401k for a tax deferred retirement savings. Some people here might work for a public service or like a hospital, and it would be a 403b, but it operates very similarly as a 401k. And then also government employees may have access to a 457, which also operates very similarly. And the max contribution for all of those mentioned, the 401, the 403, and the 457, are the max contribution is $22,500 for the tax year 2023. Okay. So again, tax deferred, you're going to pay taxes later when you withdraw the money. So you're basically going to put the money in tax free, grows. And then when you go to take it out at a later date, you have to pay taxes on it then. Okay. A traditional IRA is a type of an individual retirement account that allows individuals to contribute pre-tax dollars to their retirement savings. This means that the money is not taxed until it is withdrawn from the account during retirement. Makes sense, right? Your max contribution to a traditional IRA, though, is $6,500. But that includes what you contribute to your Roth IRA, but more on that later. Okay. So that's some examples of what some tax deferred accounts and what tax deferred means. Now let's talk about a tax exempt account. So a tax exempt investment is one in which the earnings are not subject to federal or state income tax because you already paid taxes on the money. So an example of that would be your Roth IRA. When you get your check from your employer, you've already paid tax from on that money that you've earned. If then you take that, invest it in the Roth IRA, you're putting it into a tax exempt investment account. And so as that money earns and grows and continues to grow, when you go to take that money out later, you've already paid taxes on it. So that is tax exempt whenever you go to take it out at a later date. Okay. So now that we know what tax deferred and tax exempt are, you might be asking yourself, Matt, where do brokerage accounts fit into this? And you might also be asking yourself, fuck, I forgot what a brokerage account was. But don't worry, I got you. So brokerage accounts are accounts where you can buy stocks, bonds, index funds, and other securities, like I mentioned above, right? Many options are out there with who you can go do these through, get these brokerage accounts through. Those are like including Fidelity, Vanguard, Charles Schwab, etc., just to name a few. The money earned in a brokerage account is taxed once you take the money out. Okay. So when you get your paycheck, tax is already taken. Now you could say, I want to invest in a Roth, or you may say, I want to invest in a brokerage account, or maybe a mixture of both. If you put money into the Roth and it grows over time, when you take that out, it's tax exempt. Well, if you put money into the brokerage account and it grows, and you take that money out, you are taxed on that. Now, the last thing I'll say on this is there's a difference between short-term and long-term capital gains. Short-term is less than a year, I do believe. So if you put it into a brokerage account and then pull it out in less than a year, you get taxed like crazy on it. Over 1 year, for long-term capital gains, you get taxed at a lower bracket. So it's definitely something to think about. And that's why I'm not a big fan of options trading or day trading or anything like that, because you have to be really good at it, which is a podcast for another time, but most people aren't. And it's totally normal to not be good at it. And most financial planners and people who try to invest to make you the most money long term, they're not very good at it either. So I would stick to index funds, stay away from options trading, day trading, stuff like that. You don't want to screw around with that and then also worry about your short-term capital gains. Okay. So there are different rules to all this. And like I said, I'll probably go over that in a different podcast in the future. But now that you've decided to invest and have some idea about which accounts you'd like to use or have available to you to work, let's talk about which investment choice is best for people like you and me who are long-term holders and want to retire early. That's where index funds come into play. Okay. So you've heard me say that a few times on the podcast so far, and you might be asking yourself what an index fund is. And that's where we're going to go now, because it's probably the best vehicle by which we can utilize as people pursuing financial independence. So an index fund is a type of investment fund that aims to replicate the performance of a specific market index, like the S&P 500, for example. So if you're not aware of what the S&P 500 is, it's a stock market index of 500 publicly traded companies in the US. But you might ask, how does an index fund replicate the S&P 500? Well, usually you'd have to buy equal shares of all the companies on the S&P and regularly update how much allocation you have towards each of the 500. So what I mean by that is you have to buy a stock of, say, Apple, and then buy a stock of Tesla, and then see what their market capitalization is. And so if Tesla has the bigger market cap, you would want to put more funds into that. And you would have to buy 500 different individual stocks of each of these companies in order to track the market, right? But an index fund, for example, like an FNILX, that's through Fidelity. There's nothing special about that, but if you want to look it up, for example, it tracks the S&P 500 index, and it purchases all of these companies in a basket. So say you buy one share of that FNILX with index fund, you are buying fractions of shares of each of those 500 companies, and it can auto adjust on its own. So you don't have to put in a lot of work to make sure that that index fund is still working for you. Okay. So that's pretty cool, right? You can buy one share of an index fund and it buys you shares in a little bit of everything. That's awesome. Now, there's nothing, like I said, there's nothing special about the FNILX. Particularly, it's just an investment that tracks the S&P. I'd recommend that you look into several different options to decide what is right for you. But start to look into index funds a little bit, okay? One of their main benefits of them is their low costs, since they're passively managed, okay? They don't require a team of professional fund managers to make investment decisions. This means that you make more because someone else doesn't get a cut of your gains, okay? And because index funds are set it and forget it, to some extent, we aren't trying to flip a profit real quick and time the market. You won't be subject to those short-term capital gains that I mentioned if you're investing in like a brokerage account, because what you're trying to do is put that money in that investment account and let it grow over time. Okay. Another benefit of index funds is their simplicity. They're easy to understand, require minimal effort on your part. The busy clinician with other desires in life. I mean, who wants to be sitting around the financial spreadsheets all day? I mean, maybe the people listening to this, maybe not. Like myself, I do like looking at those things, but ultimately, life is about getting out of the spreadsheet and living it to the fullest the way you want, right? I don't think anybody says that their rich life is spent in an Excel document or staring at their investment account. So, rather than spending that time researching individual stocks and bonds, you can simply choose a fund that tracks the index you're interested in and let the fund do the rest. Okay. And while index funds are generally considered a low risk investment option, it's important to remember they are not risk free. Like any investment, they're subject to market fluctuations and can experience periods of volatility, but that's the stock market. It goes up, it goes down, but historically and over long term, it has traditionally gone up. That being said, the future cannot be predicted, but I myself am going to bank that the stock market will continue to go up over time, and index funds are a great way to hedge that bet. Okay. That's that. But all of us sign up for this volatility when we decide to invest in the stock market. So there are periods of those ups and downs. It's going to continue, usually has continued to go up. I think there actually is a statistic out there that showed that when you take a snapshot of any 10-year period of time and calculate the percent gains over that 10 years, there is always a net positive increase in the stock market. So that's why when people say invest for the long term, typically you're wanting to put that money into an account for no less than 10 years, just due to the fact that almost certainly after 10 years, you're going to have some net gain from that. Okay. Whereas maybe in 5 years, you might have the first 4 years really up, and then the second year or the fifth year is way down. And then it looks like you made a net negative, but really we just didn't have enough time for things to kind of settle into place and let the market do market things and grow over time. Okay. Additionally, not all index funds are created equal. Some have higher fees or perform differently than others. That's why I want you to look into different index funds to see which one works best for you. To determine if a fund is worth it to you, you should check what's called the expense ratio. Okay. This is how much you're charged by the company to hold your money in that fund and gain profit over time. There are funds with 0% expense ratios, which is insane. I don't really know how it works. But like Fidelity has one that I saw. I'm not sure the difference in it or how they're able to offer that. Maybe it's their other things where people are purchasing uh, funds that are managed by somebody, so they're paying a higher fee and they can cut costs by putting a 0% index. I have no clue. But there are 0% expense ratios out there. But according to Vanguard, industry average is around 0.49%. So yes, that's less than 1%. That is 0.49% for index funds. So let's do some math to make sense of this all. Bear with me here. If you're driving, I'm sorry. I'm going to try to lay it out so it's as clear as day for you. So if you have, I'm going to make the math easy here. $1 million. Okay. If you have $1 million invested in an indexed fund that has a 0.49% expense ratio, at the end of the year, that managing companies, let's say Fidelity, they will take $4,900 from you, $4,900. Now let's compare that to an index fund that has a 0.04% expense ratio, which there are, like I said, out there. VTSAX through Vanguard is their total stock market index fund, and it has that 0.04% expense ratio. So at the end of the year, that same $1 million, they only will charge you $400. So that's a difference of $4,500. Maybe when you're a millionaire, 4,500 ain't much to you, but it's more money that is yours to keep and spend however you want. Okay. Now let's compare that to an actively managed fund. So the thing I've spoken diligently against through this time. So for example, just a great example is one of my retirement accounts. I'm unable to invest in an indexed fund because it's through my employer. So I found one of their lowest fees with good performance accounts, but the fees come out to 1.7%. Now, I don't have $1 million in that account by any stretch of the imagination, but let's assume that same $1 million in this account invested like before, they would take $17,000 per year. So let's think about that again. $1 million in this account, I have to pay out $17,000. $1 million invested in, say, that Vanguard account is 0.04%. They only take $400. So you're paying $16,600 extra dollars per year just to have maybe marginal gains, if any improved gains. I think if you can look at their growth, both of their growth over time, and they probably have very, very similar gains, and you're losing money on that, right? So expense ratios, if you didn't think that they mattered before or didn't know what they were, I hope you do now, and I hope you look at what your expense ratios are on your investment accounts. Actually, action item, that's your homework. Go look at your expense ratios right now, this week at some point, and see what they are, and email me or Instagram me on or DM me on Instagram. I want to know, like, what were they, and then what are you going to do about it? Okay. I know this isn't even getting into financial planners, but they take a piece of the pie as well. If they have assets under management, something we'll talk about more in the future. But financial planners that are assets under management, they may take 1.5%, 2%, depends on how much money you may have with them. But I encourage you to look at those current investments and start investing now if you can. Do some research on what your ratios are and let me know over on the Instagram channel. DM me, Unlock FI Rehab. Let me know your expense ratios. I truly want to know. I want to have this conversation. I want to help you guys learn these things. Okay. Check those out. Let's keep the conversation going. Join the Financial Independence for Physical Therapists Facebook group. Follow me on Instagram and YouTube at UnlockFI Rehab on all platforms to keep getting information just like this. Subscribe to the monthly newsletter. But until next time, y'all, peace.